In the past, lords and ladies constructed castles and dug deep moats around them to keep intruders away from their wealth and well-being. Fortunately, people today do not have to worry about their lives as much as they did in the past, but businesses still do. Companies in a capitalistic society operate in a fiercely competitive environment where, if you happen to find a particularly lucrative business niche, competition will come after you. Warren Buffett, our hero, loves incredibly profitable companies, but he also despises it when the competition steals these profits. Buffett contends that the presence of a moat around a company's castle is therefore perhaps the most crucial factor to consider when making stock market investments. He also doesn't want tiny ponds. These moats should be as broad as possible. We consider that moat to be the main criterion for a great company, along with the ability to maintain its width and its impossibility to be crossed. Additionally, we inform our managers that we want the moat to be widened annually. One of the most crucial abilities a value investor can have is the ability to recognize businesses that can remain profitable over the long term, which you will learn how to do in this video. Wall Street Wisdom is here to provide you with the best advice and resources for using stock market investing to achieve financial independence. So make sure to like and subscribe for more valuable information like this. What is a moat? First and foremost, it's similar to having an exceptionally attractive partner to have an exceptionally successful business. You are aware that competition will exist for such things. In both situations, you'll need a long-lasting competitive advantage if you want to maintain your atypically advantageous position. That's a mouthful, but let's break it down because this is exactly what Warren Buffett means when he talks about a moat. According to Wikipedia, a competitive advantage in business is the quality that enables a company to outperform its rivals. Overperformance typically entails higher profitability, higher return on capital, and/or large market share when compared to peers in the same industry and businesses in general. This is the dark art of investing, the kind of thing that makes it so that the best investors aren't always academics with exceptional mathematical abilities. Because it is very challenging to quantify the durability of a moat. There is no exact formula that tells you, for example, that the moat is 28 feet wide and 16 feet deep or anything similar. You must comprehend business operations. People struggle to recognize moats because they are difficult to measure. And when the herd is experiencing difficulties in investing, can you detect that? What is that odor? Opportunity. The crucial question to recognize moats. When we purchased See's Candy in 1972, I asked myself, if I had $100 million and wanted to go in and take on See's Candy, could I do it? You know, every time I look at a company. We bought See's Candy after I came to the conclusion that it was not. Similar words from Buffett about replacing Coca-Cola as the top soft drink producer, but with $100 billion. He comes to the same conclusion. It is impossible. You can tell that a company has a very wide moat when it is impossible to overthrow it even with $100 billion and the business is earning $7 to $10 billion annually. Entrepreneurs who understand expected value won't even bother competing in these kinds of situations, and those who obstinately try anyway will suffer the consequences. But keep in mind that finding the answer to this question is an art, not a science. You can probably learn the art the quickest by looking at a few of Warren Buffett's most significant investments. The Berkshire Hathaway business moats. It's likely that you can determine whether a company has a moat if you can put yourself in the position of a customer. Here are a few examples I'll use. For a very long time, Coca-Cola dominated the global soft drink market. Every day, beverages made by the Coca-Cola Company are consumed in nearly 2 billion servings. Additionally, it hasn't sacrificed profitability to achieve this market penetration. What is it about Coke that is so unique? Coke's moat is collectively referred to by Warren Buffett as share of mind. He is saying that the Coca-Cola brand name has a positive connotation in the minds of billions of people around the world. They probably associate it with refreshment, or happiness, or something similar. Additionally, a Coke is always within reach for customers who want to feel revitalized thanks to the company's outstanding distribution network, which also serves as a moat. The company wants its customers to keep drinking Coke, so they shouldn't ever be pressured to switch to another beverage, like the Swedish Cuba Cola, just because there isn't a Coke store nearby. These factors make Coke's competitive advantage sustainable, and they will probably still exist in 20 or 30 years from now. Apple, which is currently by far Buffett's largest public investment, is another company with a sizable moat. Similar to Coke, it has a strong brand name and a high share of mind, but there are two additional factors that I'd like to draw attention to. The first is that network effects for Apple are significant. This implies that the Apple community becomes more valuable the more people who join it. More app developers want to create apps for the App Store as more people use iPhones, and this cycle continues as more people use iPhones. Then there are the effects of technical lock-in. Although it may not be as significant as the aforementioned factors, I always find it difficult to navigate an Android-powered phone. I just can't be bothered switching, even if a Samsung costs $200 less than an equivalent iPhone. Not only would I have to relearn how to use the phone, but I'd also likely run into some issues when transferring my data. I'll probably keep purchasing iPhones for the foreseeable future as well. The other one of the two truly enormous railroad companies in North America is BNSF. There aren't many choices in this area if your business needs to transport heavy loads over longer distances and you care about the cost of transportation. Why? Because constructing a railway network akin to BNSF's would require an enormous amount of money, time, and confirmations from local authorities. A second railroad isn't simply built next to the first one. In many cases, there isn't even enough room for that. As a result, it will be very challenging to replace BNSF's successful operations. The third most significant investment Warren Buffett has ever made is See's Candy. He invested about 40% of his net worth in this premium chocolate producer in the 1970s in exchange for a 100% ownership stake. That was a sizable wager, and it was successful. Similar to Coke, See's has a share of mind advantage, but only regionally in California. There is one more benefit, though, and it differs significantly from Coke's. Its premium chocolate is only occasionally and on special occasions purchased. Will you save $10 to choose the new, less expensive option when you purchase premium chocolate once a year for your loved ones, such as for Valentine's Day? The second largest auto insurer in the United States, Geico, is also Warren Buffett's best performing investment overall. I believe it's fair to say that Berkshire has almost amassed a thousand-bagger from the 33% stake in the business that he bought between 1976 and 1980. In any case, Geico has a sustainable competitive advantage because it is the less expensive option. Auto insurance is a pretty dang big expense for most households in a sector where cost is important to customers. It is advantageous to produce commodities at a low cost. And given that Geico appears to become more cost-effective as it expands, this advantage ought to be one that is long-lasting as well. Not every moat is created equal. You'll probably notice a recurring theme if you look at the businesses that were just mentioned. They have played the game for some time. The FTC sued Facebook for illegal monopolization in December 2020, essentially claiming that the company had a position in the social media industry that was too dominant for too long. The strongest moat one can have is a monopoly, but in hindsight, it's fair to say that such concerns were a little out of the ordinary. The question of who will remain the dominant force in social media is still up in the air, in my opinion, given how quickly a company like TikTok rose to prominence. Facebook does hold a dominant position in the market, but if I had to place a bet, I'd say that Coke will most likely dominate the soft drink market in 30 years, rather than Meta, which currently dominates social media. And it appears that Warren Buffett holds a similar view based on his investment choices. Usually, if something can quickly gain a competitive advantage, you have to be concerned about them losing it just as quickly. Many individuals believe they are the ones who will survive or prosper when an industry is in transition, but this often proves to be untrue. And indeed, not much has changed in the past century regarding the operations of Coke, BNSF, See's Candy, and Geico. You can't always say that longer is better because real success has only recently emerged for some companies, such as Apple, but it's still a strong generalization. The latest trends should no longer be followed by wise investors. Old is gold. Identifying companies with moats quickly. Now, you might be wondering, well, where do I start? What area should I visit to search for moats? I already mentioned how challenging it is to evaluate the sustainable component. You've only recently learned a few tips and techniques for doing it, but in-depth business and industry knowledge are still indispensable. However, it's not that difficult to determine whether a company currently has a competitive advantage, and this is a great place to start. We often make decisions based on the past. Generally speaking, if something has a bad history but a promising future, we will pass up the chance. To do this, I advise you to visit a financial data provider. Check out my video on Warren Buffett's 25 most significant investments ever if you think you're not quite ready yet. It has amazing moats all over it. Thanks, guys, for watching. Make sure to like and subscribe. See you on the next video.